All right, good evening, everybody. Thank y'all for joining the Stratton Park Apartments webinar. Super excited to really go through the investment from a macro level, why we love the deal, a little bit about San Antonio, the market that we're buying in, and then, of course, the property, Stratton Park Apartments. So, just to start off, this is a disclaimer. This is not an offer or solicitation to purchase securities. We always recommend to talk to your tax, legal, and other advisors. Nothing in here really has forward-looking statements. These are our assumptions along with our management company. So uh, just know that this has not been reviewed or approved by the Securities Exchange Commission. Other disclaimers, this is a 506c offering for accredited investors. If you're not sure what an accredited investor, if you are an accredited investor, we'll explain that later on in the presentation, but just want to be respectful of everybody's time. If you're not able to make the entire webinar recording, will be sent out tomorrow to all those that are on this call. I also have QR codes if you want to do a soft commitment. A soft commitment is not anything more than saying that you're interested and this is the placement. And then we have first come, first serve. We've got a lot of people on tonight's call. So if you are even considering about investing, definitely do the soft commitment. It just puts your place in line for the investment. So there are several reasons why I love this deal. Mind you, our last multifamily investment we purchased was August of 2024. It's taken us many months to find opportunities. And one of the things we've been looking for are distressed deals. Now, this property is not a distressed property. It's over 90% occupied, but the seller is in a distressed portfolio situation. And so it's a unique opportunity. And that last year they bought this property in March. And here we are about a year later, we're buying it for $3 million less than what they bought it for in 2024. So day one basis right there, there's 3 million. But we are super excited because this deal came to us through a broker relationship. There's no offering memorandum. It didn't go out to the world. It's just through a broker relationship that we have there in San Antonio that was like, hey, this is a great opportunity. You want to look at it? And of course, we said yes. We've been trying to buy into San Antonio really since 2021. I've been underwriting property after property in San Antonio, and numbers don't work because, like, I would submit a bid on a property and then I'd get outbid by $1 million. So think about Austin, San Antonio, a lot of growth, a lot of demand. And so I just didn't buy there. And so Houston was where I was able to find value and continue finding value. But this really has opened it up for us having this opportunity just for, exceptional reason number one, buying it 3 million less than what the seller bought it for last year and 800,000 less than the Bear County appraisal. And that's huge for taxes. And we'll talk about that shortly. The second reason I love this deal, it's a 1985 asset, clean bones as far as wiring and plumbing and roofs were replaced in 2019. Like this is a solid deal where we were buying like early 70s product at a much higher price per door. Now we're buying, mid 80s, early 90s product for prices that were just unreachable, just a couple years ago because of the demand that was happening. This property, and we'll go into the submarket, but it's in the Arboretum submarket of North San Antonio, so a growing area. And so we just love that the property is of good age and in good location. At the end of the day, real estate just matters location, location, location. And this property doesn't disappoint in that. And then really number three is what we're all looking for is cash flow and tax depreciation. Every deal we've done over the last 3 years has cash flowed day one. We have not hit our missed distributions on any of our assets that were not developed. Now, the ones in development are still being developed as part of the process of the lease up, et cetera. But all the properties like this, they are cash flowing and they produce an amazing amount of tax depreciation. And with tax season now, we're sending out K1s and there's just a really good amount of tax depreciation happening for our portfolio. And so you can do that when you're buying an asset 3 million less than what the prior seller does. And you're doing it with fixed rate debt. So all of our properties that we buy are fixed rate debt. We do not use bridge loans. I don't have any bridge loans on our portfolio. And we'll talk about that with inflation on a couple slides um, from here. But right now our fixed rate debt is 5.34%. What's great about the market right now, if you can say that, and I'm very bullish, I think things are really great for real estate guys, is the treasuries are going down. And so as treasuries go down, the rates for multifamily in particular go down. So 5.34 was the rate we were quoted a couple weeks ago. And so as we go through the loan process with Fannie Mae, this loan actually may decrease for interest rate. So it's not your multifamily ordinary deal. We only do maybe two, three at the most a year. We don't have a lot of deals that we send out consistently. And the reason is because we're just underwriting and trying to find opportunities. And trust me, we have investors who are like, hey, when's your next deal? When your next deal? And I'm like, nothing really works. And so here we are, finally finding something that works since our last investment. So let's talk about why multifamily investing. At the end of the day, everybody needs a place to live. It's a risk resilient, basic human need. We all need shelter. And so, especially in the Texas Triangle, there's a lot of growth, a lot of people moving to the Texas Triangle for jobs and cost of living being a lot cheaper, et cetera. And so when you have housing and you have population, the demand that's coming, it just is something that I really feel like when you compare that to office or retail, things that could easily, like if the economy just goes spiraling out of control, people can close their doors at night and move their stuff from an office standpoint, but people need a place to live. When I worked for CBRE, I saw that during 08, 09 in commercial real estate, where a lot of the offices, a lot of the retail, they would, you know, move out in the middle of the night and then we would come in and check on them and the next day they were gone. Well, multifamily housing, I don't see that risk. It hasn't happened during COVID, hasn't happened in other cycles, because at the end of the day, people want a roof over their head. The other thing is I like about multifamily is the best risk adjusted return among other asset classes. So whether it's office, retail, industrial, I mean, those are all great in their own way. But multifamily has always led the pack from the investment cycle of returns over a period of time. Has multifamily had dips? Absolutely. But over a period of time, it has prevailed. It's done extremely well, and is outbeaten the hotel or retail and office. And so that's another reason why I like the multifamily. Obviously, cash flow and equity appreciation is massive. From a cash flow standpoint, we're not buying deals, and we haven't bought deals that don't cash flow over the last few years. So if they don't cash flow day one, we're not buying it. All of our deals recently, and I said in the last few years, have like Q1 after buying the property, we're distributing cash flow. Equity appreciation as the market increases and the demand increases, supply lessens, and we're paying off our debt. There's a lot more equity appreciation that's being paid for by our residents. And going back to tax benefits, we there is talk about going back to 100% depreciation. I think that's a very good possibility. But even still, we've got really good tax benefits through a cost segregation and providing those paper losses for investors. So this slide is not normally one I have, but I put it in for this one because I feel like the timing of it's particularly good over the last couple of weeks. Stability during market volatility. So I don't really care on our portfolio what's going on. That's me personally because most of our investments are in real estate. Everybody's going to be a little different. Everyone's going to be diversified different, but I don't have to worry about an Elon Musk tweet. I don't have to worry about what's going on in China. I don't have to worry about anything other than the submarket that we have properties in. At the end of the day, the first of the month rents are due, and we are really dependent and driven on that local economy. So no matter what's going on in the outside world, as long as the submarket and that market is doing, and even in not even the market as a whole, just more so the submarket, um, no matter what's going on in the outside world, the volatility, which is going to happen, there's going to be ups and downs. We've seen it. Many of us that are on the call have seen multiple cycles of this. and we don't get scared. Actually, we get in the mindset of buying. Those people that didn't run away from real estate in '08 and '09 made an incredible amount of money. Um, I was getting out of the Marine Corps at that time, so I didn't have a whole lot of money, but I was in commercial real estate and I saw a lot of people like, oh, the media saying this, doing that. And so people, didn't invest. And I just thought to myself, like, man, if I would have bought those stocks, that real estate, if I had that opportunity during that time, it would have been a great lift to our portfolio over the long run. Not even the long run, 5 years later, it was just incredible. We saw that during COVID. People got freaked out, stopped investing. Those people that went in when things didn't look good, they did extremely well over the next, few years. So stability during market volatility is huge, especially with multifamily. Inflation, there's no better asset to invest in than multifamily when we're thinking about inflation, especially when we have fixed rate debt. So if fixed rate debt's happening, say in this case 5.34%, rents follow inflation. So if inflation is going up, inflation's going up, but what's staying consistent is our taxes, or excuse me, our mortgage, our fixed rate debt. So it's a built-in inflation hedge. As I was mentioning on the stability during market volatility, local performance, not global panic. I just think that's really timely right now. And then lastly, the demand grows during both market instability and stability. We've seen this across our portfolio in Texas in particular, where there's just a lot of growth. And even we can't deny that there's been a lot of supply in certain markets. But there's not any new permits going out. And so when you think about like, okay, over the next 2 years, that supply, say in San Antonio, there's 100,000 units that gets absorbed per year in San Antonio. Well, if that's the case, like in 2 years, there's no inventory. All the supply is gone because it's all been leased up. And so that's going to drive rents, that's going to drive demand. And then that's when the developers start kicking off their developments again. So these are these cycles of real estate with oversupply, undersupply, et cetera. So anyway, I added this slide because I just feel like this is an appropriate time to really remind people, investors like you and myself, that, going into real estate, buying a hard asset, you are owners of this property with me. And it's tangible, and it doesn't matter what's going on in the outside world. We're living in, or we're investing in a physical asset. So a little bit about myself. I'm Wayne Courageous. I have been in commercial real estate my entire career out of the Marine Corps. So I went to high school, obviously, went in the Marine Corps, and then got out in 2007 of the Marine Corps and was with CBRE for about 16 years. I started CREI Partners while working for CBRE in 2019 and grew it to a point where I couldn't do both the W-2 job and CREI Partners. So in June of 2023, left my full-time W-2 and went all in on CREI Partners and our investments. I have an MBA from the University of North Carolina. I host a monthly meetup, which I see a lot of people have joined from that meetup, which is amazing. But we meet on the fourth Monday of every month virtually. I've got a podcast, Untold Stories of Real Estate Investing. We're actually about to launch another podcast soon for passive investors. And then I'm a former U.S. Marine, as mentioned, Eagle Scout, and member of Rotary Club of Bryan. So we've added on two team members, two full-time team members. One is Shelby Whitaker. Many of you, if you've invested with us before, you know Shelby. She handles all of our investor relations and really the hospitality experience of once you invest with us between K1s and the investor portal, any questions, the monthly updates, etc. Shelby really handles a lot of that. And then, of course, I support along the way too. For any of y'all on the call who have invested with us, you know that I'm very responsive. We share our monthly financials. We're very open book and transparent. And so hiring someone like Shelby to join my team was really, really important to continue elevating the experience as we grow our properties. On top of that, we hired Will Swenson earlier this year. Will has several years of asset management experience, and so he's taken on the full-time role of leading our asset management. And that was really important in a strategic hire because as I was growing and buying more properties, I was doing a lot of the asset management. And so when I hired him, it was a strategic move to take care of our properties. We're not going to be one of those companies that grows too fast and can't take care of our investors and our properties. So hiring Will to work and partner with our property management companies that are third party was essential to our growth in business. We've got over 50 million assets under management. We are lead sponsors on these properties, Ivy at the Galleria, Candle Ridge Park Apartments, Majestic Apartments. We have two 20 by 50 storage facilities, one in Bryan College Station and one in Huntsville, Alabama. We have a build to rent community that is a 98 single family home development that's, think about like a horizontal multifamily versus like a vertical multifamily. We are developing a multifamily development in Bryan, Sam Rayburn Apartments, 150 units. We'll be launching that soon. And then we have a medical retail in Alabama, 8331 Madison. Partners on this deal are essential. These guys I've partnered with previously and just have a lot of respect for, a lot of trust. When things, nothing from a passive investor, you're interviewing the team or you're going through the due diligence of us as me as the general partner or the jockey on the horse. But for me, I'm looking for partners who, when things get tough, and I'm saying to the sort of the general partners, when things get tough, are we working together? Are we, getting through any of the challenges? Because no property is ever going to be easy. But if you have the right team, we're working together and collectively. So, Dr. Rajkumar Venkatramani, I've known him several years. We recently partnered on Candle Ridge Park Apartments. He's the owner of Redoc Agency and manager of Redoc Capital. Owns and manages several rental properties in Houston. Invested in as a general partner, limited general partner over 2,000 apartments over the last 7 years. Dr. Adebayo Fasanya, he's the founder and CEO of Dr. Breathe Easy Capital. He's invested in multifamily since 2015. He's got over 184 million in assets and over 1,800 units under management. We've got Donald Lindsay, 17 plus years of managing expansion of private equity-backed companies through acquisitions of companies in real estate. He leads the investment and acquisitions of companies with a total valuation of over $1 billion across diverse assets and industries. And then we've got David Priest, 20 years as a full-time real estate professional, general partner on over 600 units of apartments, limited partner on over 1,000 units of apartments. These guys are on weekly calls on our properties with our property management company, and we're guiding the budget process, the monthly performance. We're getting daily KPIs from our software. So this is the team, including myself, who are going to be running day-to-day asset management. All right, so let's talk about San Antonio. I absolutely love San Antonio. I grew up in Austin. We all know the Alamo's in San Antonio. If you watch the Final Four and the championship last night at NBA, that was obviously in San Antonio. Just a beautiful city and great people. If you like Tex-Mex, definitely head to San Antonio. Great culture, great food, just great people all around. We're going to go through all the accolades here shortly. But it's among the 24th largest U.S. metros. In 2023, it had the fastest or the largest growth in population. So it rated on the U.S. Census as number one. And think about it, there's over 2.7 million residents in the metro, which is the second largest city by population. So other than Houston, San Antonio in the metro is larger than Dallas. It's also the seventh largest population in the city limits, which is just massive. It's crazy. The U.S. Census fastest growing metro, number one rank. 2023 population growth was 22,000, and the expected population by 2034 is 3.5 million. And the employment growth 2014 to 2024 is 25.2%, and the national average is 14.2%. So a lot going on for San Antonio from a growth, which really drives with jobs, cost of living, and just a lot of great things to do around San Antonio. It's been a strong performance over the past 10 years, outpacing numerous growth markets and percentage of population and employment growth. Houston is a market that we're really bullish in and we've bought a lot in. But San Antonio has been a market that, like I said earlier, has been a property or a city that I've been trying to buy in for a while. There's been 18% growth in the last 10 years, 25% on employment in the last 10 years. So this is up there with Nashville, Dallas, Charlotte, Jacksonville. I mean, a lot of the cities that, are heavy growth And not a lot of people are talking about San Antonio. That's one of the reasons I'm, very bullish and been trying to buy because there's just been a huge amount of growth here over the last 10 years. Other accolades, fastest growing city, we mentioned that. It's the second biggest city in Texas with a metro size the size of Chicago. It's a larger population than the entire state of New Mexico. There's a diverse economy, tech, healthcare, military, energy. It's home to five-time NBA champions, the San Antonio Spurs, and two major amusement parks. They've added 36,000 plus jobs in 2023. It's a top U.S. tourism hub with 40 million plus million visitors annually. And it's home to Joint Base San Antonio with 80,000 military personnel. San Antonio has a global presence, $580 million in exports in 2024. Obviously, that relates to strong trade ties. There's 11 million passengers handled by San Antonio International Airport for 12 months ending in December 2024. And Toyota's $531 million expansion added 400 plus jobs. There's consulates for Mexico, Japan, UK, and more. Home to 6 Fortune 500 companies. There's 47 nonstop flights to US, Mexico, and Canada, and it's home to 400 plus companies with global operations. San Antonio is a city that's just going to continuing to grow. Obviously, with strategic location near Austin, that whole area. When I was growing up, thinking about Austin, San Antonio being one mega city, and that's true. If you've driven I-35 between Austin and San Antonio, it is one massive city, and that's just going to continue to grow. So it makes perfect sense why San Antonio's had a huge global presence. We're going to see growth over the next 5 years. So this is according to JLL, 5% employment growth, 13% GDP growth. We hear a lot about Dallas. We've been hearing a lot about Vegas and Orlando. I mean, San Antonio is in that pack of properties. So excited to see that continue for San Antonio. So if you're not too familiar with San Antonio, so San Antonio is southwest of Austin. So this is on a macro level, but obviously here's Austin, come down San Antonio. Now in San Antonio, just like any market, there's places that you want to buy and you don't want to buy. Where you want to buy obviously is location and the growth. So if you think of North San Antonio, if you're looking at San Antonio the way it is now, and you say, okay, imagine it being a clock at 10 p.m. and 2 p.m., sort of in that quadrant between 10 p.m. and 2 p.m., that's the area of growth and where you want to be looking and where you want to be buying. On top of that, a lot of cities, the inner loop tends to get the most rents and the most growth. So in this case, 410 is the inner loop. That's not the case in San Antonio. The growth and the rental and such is outside the loop. So with Stratton Park Apartments being outside the loop and within that 10 p.m. to 2 p.m. quadrant, it's in the line of growth, especially close proximity to 35 and Austin. So from that standpoint, I just wanted to show that map of like just getting a visual of where Stratton Park is located. Then we get in a little more dialed in. So north central San Antonio is where Stratton Park is located. Look how close it is to the San Antonio airport. It's about 7 minutes. Most cities, the San Antonio or any airport, you really don't want to live nearby. Like it's not a place to live. That's not the case in San Antonio. It's really a nice area outside where near the airport. This is a very, very, we'll talk about the Arboretum submarket in particular, but a very, very nice area where like I personally wouldn't mind living and, raising my family. It's close to Castle Hills and a lot of great other submarkets. So with all the restaurants, it's walking distance to Target, walking distance to HEB, excellent schools, parks, and entertainment, 13 miles away from downtown, easy access to major highways, 19 minutes if you want to go to Six Flags Fiesta, Texas. It's a great location and a great submarket. So we started at the macro of San Antonio. We're dialing it in on what region, North Central, and now we're going to be really talking about the Arboretum submarket. So within the Arboretum submarket, we've got 29,000 employees, over 2,835 companies. 47% of the population has a college degree or higher. And this is a stat I always look at is what's the rental versus homeowners. And 49% of the rentals are or occupied households. So there's a strong rental market. The other thing that, I always look at, especially the last couple of years, is, what is the supply that's coming online over the next, few years? They've got 350 units of multifamily expected through 2025, and they've got absolutely no new starts. So if you look at the submarket occupancy, that's a little down. The property is 90%, so it's trending higher than the submarket. But as those 350 units become occupied and there's no new supply, and more people are continuing to move to the area, this submarket occupancy is just going to increase and increase. And so this is a stat that I'm always looking at. And then the other thing I'm looking at is crime. At the end of the day, I can make a property beautiful, I can do different things, but you can't really change an area. This is the lowest crime area that we've ever bought, and I have a map of it. It's green. It's like nothing's going on. And that's just a really good testament of this area. Looking at submarket occupancy rate, 86.5%. Population 1 mile is 7,545 people, with over 83,000 people within 3 miles. The population growth from 24 to 2029 is expected at 5.58%. The median income is outstanding at $64,000. So when we look at like what our rental rate compared to what the median income, it absolutely supports the rental rates that we'll be looking to do. Daily asking rent per square foot is $1.49. So between proximity to the airport, low crime, numerous office and residential buildings, abundant retail and option and restaurants, North Central and more in particular Arboretum, really is a great place to live. And when I say like my family and we would live there, like it's the truth. When we did due diligence, we walked around like this. It's a really nice neighborhood. So let's talk about the property. We talked about the city. We got into the submarket. We're now going to talk about the property itself. So it's 127 units. It's a mix of 72 one bed, 22 two bed, and then there's a separate property, maybe like 500 feet across the road that have townhomes. So it's pretty unique where it has like your traditional multifamily, and then there's 21 bed townhomes and 13 two bed townhomes. There's pools on either side of the road. There are 13 residential buildings, one leasing office. Apartment rental rates range from $789 to $1399. So going back to the median income, absolutely supports increased rents from this. 40 occupied units are well below market, and we'll talk about that through our business plan. But the apartment community also offers amenities, reserved parking, laundry facilities, access to bus transportation, community grilling, seating area. And you'll see some of these pictures as we move along. But a lot of the units are in this type of shape. You'll see black appliances. You'll see, carpet. Typically, you see carpet in the upstairs and wood or vinyl flooring on the first floor. That definitely helps with like the sound. But, fireplace, all in all, really nice units that will continue doing minor renovations. We don't plan on spending crazy amount of money on interior renovations. When I say crazy, I don't expect to spend 8 to 10,000 a unit because you're not going to see the huge increase on rental rates to offset that type of investment. But we'll do moderate increases, and if we're able to get a $7,500 rent bump, we'll do extremely well, and it'll be well within the business plan. So that's part of being conservative. Is like the days of like pushing $150, $200 rent bumps. Like I don't live in that world anymore. $7,500. If we can do that and it makes our business plan work, then fantastic. So the market will change and the $150 and $200 rent increases will happen over time. But that's not how we want to underwrite it. So a little bit more into this. I have budgeted, and we'll go through our pro forma 3% rental increases. And on our portfolio wide, we have typically a 5 to 7% rental bump. And the reason we have that, despite what's out there in the world of like negative rent growth and a lot of concessions, is because if people like those 40 units that are already below market, a 3% rent bump is like $27 or $30. Even if they paid that $30, it would be more expensive for them to move out than pay the $30 rent bump. And where are they going to move? Because if they move down the road, they're going to be paying market, which is higher than where they are paying now. And so, we feel very confident that we can get 3 to 5% rental increases from the existing population, take care of them from a resident. I mean, they in return, we take care of the property, obviously have great tenant relations or resident relations, creating a culture where people want to stay, et cetera. It reduces the tenant turnover, reduces the expense, and we can grow the property without having, people be leaving because it's, a crazy amount of money to live there. And so these are all things that we look at to reduce risk. Um, when you look at a value add standpoint, there's deep value adds. That's not this property. It is a value add property, and there's going to be opportunities and to grow rents, but we're not having to do it by getting 20, 30 of the residents out so that way we can renovate and push. It's really all organic rent growth. Once they were to leave, give us notice because there's going to be natural churn. We do modest renovations and we get them back. But the property has beautiful live oaks. The roofs were replaced in 2019. The pools look great. The sidewalks, there's two pet parks. Again, I mentioned there's fireplaces, outdoor grill. I mean, this is a solid Class B asset in a Class B neighborhood. So I want to do a quick video here. All right, so we're going to continue talking about the property. I want to pause there real quick. Reminder, the QR codes. I'm seeing a lot of soft commitments starting to come in. Thank you for doing that. Soft commitments does not say you're absolutely going to invest in the deal. It just puts you in line, so that way we hold your spot. So definitely use that QR code if you have any interest in investing. Go ahead and go through that process. All right, so going back to the property, other things we're looking for: copper wiring, HVAC, roof, plumbing, electrical inspections were all complete. We met there a couple of weeks ago, ran cameras through all the plumbing between the buildings, all PVC. There were some areas that will need some maintenance, need some repairs, but overall, no major concerns. Electrical, there's no stab lock breakers, Federal Pacific, nothing that's going to impact our insurance or need replacements. Exterior railings and soffits were recently painted in August 2024. You probably saw a lot of that in that video. Roofs again mentioned were 2019. So what are the things that we have to do? Well, some things over time, HVAC unit replacements, that's normal R&M. We're going to be looking at adding washer and dryers to units and doing a property-wide leasing program and actually owning the washer and dryer. So all that rental income comes directly to the property. We've done that on a couple properties and it's done extremely well. Pressure wash all the exterior. As you saw in that video, there needs to be some pressure washing, need to be restriping of the parking lot. Like all that's easy, low-hanging fruit things to just bring up the property appeal. The pool near the townhomes needs to be repaired. The pool by the other main properties is looking good, but we'll have to do some repairs on the other one. Looks like a pool pump. And then we'll perform exterior paint repairs on that side. But a lot of our value add is the renovation of the 102 of the 127 units during the first 3 years. And again, it's really important, minor upgrades. Like I'm a really good landlord owner in the sense that we want to really take care of our residents, provide events, etc. But if we're not going to be that owner that goes through a CapEx budget year one and then we don't have money for a rainy day. So there'll be some renovations that happen, but it's going to be very thoughtful, mindful, and especially if we're able to get a return on investment, those are things that I might be looking for. And that just goes with experience. I've had a property many years ago where you go in, you add and do all these things, you make it to where it's like a place you would want to live. And then you realize like they don't really care about that. They want a place that's affordable and, safe and convenient to their work. So other things that we look at as investors is the FEMA flood map. Real estate is already risky, so why add the risk of having a property in a flood zone? So this map here shows that this property is not in a flood zone. The other thing, as I mentioned, this is the greenest, best crime report I've ever had on any of my properties, but it is in the green. And so I just wanted to show and highlight this is that, even though we're close to the airport, the crime in the area is very solid. MLDC Management is a company that we have worked with on 3 of our other assets. They will be managing this property for us. This property is a very much of a boutique type company, and that's a very good thing because I've had management companies that were very large, 20,000 plus units, and I felt like just a number to them wasn't getting that personalized experience. I know the owner extremely well at MLDC, know the regionals, and they will do a fantastic job. They turn down so many people to get that one lease, and that's the type of work and type of management company you want. So that way we're not dealing with evictions. On our properties, we don't have high bad debt. We don't see a high eviction process. And a lot of that's just because of their screening factors. There are people out there that are concerned with what's going on geopolitically that a lot of people are going to, that are not documented workers are going to have to leave. Well, that's not the case in MLDC because all of the people that rent have to show proper paperwork. And it's not a political discussion other than it's really important that you have a management company who is being strict and following that to the T. And another thing for me that's important is to have third-party management. There are things that one days I'm like, hey man, it would be nice to be vertically integrated. But it's also nice to know that there is, and I'm speaking to y'all as a limited partners, it's nice to know that your general partner isn't vertically integrated on the deal. I'm an Eagle Scout, Marine, like I like to sleep at night. I don't have ethical issues or concerns, but there are people out there when they're vertically integrated, they start moving money from a bank account to bank account and it starts, fudging numbers. When you have a third party, that just absolutely will not happen because they're not going to risk their reputation on that. So this is one of those things for me. It's just having a third party. It keeps that arm distance. It makes sure that is professionally being managed for our investors. So MLDC's outstanding company. They were also a big part of the due diligence of the property, doing the physical, also the lease audit, and then the budget as well. And we'll go through that operational budget shortly. So rent comparables. 1 bed, 2 bedroom, $1.43 average a square foot for Stratton Park Apartments. And so as we go through the next slide, just think $1.43, and then I'll summarize on a couple of slides here. But Altamonte is just right down the road. It's 0.3 miles, $1.60 a square foot. So this is a competing comp for us. Their per square foot is a lot higher than ours. Harper at the Park, it's $1.42. It's an older property. It looks older, 0.7 miles, but still within the range of where our rents are. I would say Altamonte is a better comp. It's a near our age property. It's a much larger 432 units versus our 127 as well. So other properties, Arbor Hill is about $1.36 a square foot. And then you got 550, which is $1.52 a square foot. So when you start averaging them out, they're about $1.49 on the average comps. So the subject being Stratton Park, we're at $1.43 a square foot, and the comps average is $1.49. Put these pictures up there just to show some other looks of the interior units. But I love this roof. It was replaced in 2019. Those are expensive, so that's a great thing we don't have to worry about during our ownership. All right, let's nerd out on some numbers. This is something that I love doing. I don't outsource this. I really dig in on the numbers. And one of the things I like to do it from a macro standpoint. Now, this seller, I mentioned is having a portfolio distress situation. The property itself is not distressed. But still, when they vertically manage the asset, uh, naturally there's going to be if your portfolio is distressed, there's going to be stress on the employees to perform. So on this income for the T12, they're at 1,503,000. On our year one, my number is less than the 1,503,000. I'm anticipating that we will have some move outs, that we will have some bad debt that people were put in that they shouldn't be. And so those are things that we look at. If you see on the rent concessions, and the bad debt, like I'm anticipating that we will still have those things. Vacancy loss, I expect we will have some evictions. Like that's very normal. And that's okay because it allows us to get the property stabilized with residents that are going to pay their rent, et cetera, within the MLDC guidelines. I mentioned the annual rent growth up here, the 3%. Again, that's, some people are like, well, there's negative rent growth. And that's true. If it's a Class A property, there's not a lot of rent growth because there's not a lot of value add. They're already at the top of the market. But when you're already below market and you're less than even a lot of the units that are in the apartment, you should be able to get 3 to 5% rent growth. Again, that's only like when you think about it, like on a $700, that's only like $25, $30 rent bumps, and we're able to do that. So on our performance expenses, our expenses for property management fee are 3.5%. General and administrative, $325 a unit, so it comes out about 41,000. So this is how we would operate any of our properties. So we feel very confident in these numbers. They're also higher in most cases than the existing seller. And obviously, we're going to try to reduce expenses where possible, but we're not fudging and making numbers look better just to try to, get the deal to work. Like if contract services could easily like, hey, 24,000, but it's like, no, we've done all the work. We know that trash, pest, security, pool services, we're going to be closer to 35,000. Marketing, we're going to be probably having some move outs, so we need to be, spending more on marketing. Payroll, I don't know what they were doing for 125,000, barely get a person for that. 170,000, I feel very confident we can get a maintenance person and a manager. Repairs and maintenance. Now, thinking about replacement reserves, our repairs and maintenance, and our capital, we'll spend about 25,400 in R&M for the year. And then this is sort of a catch-all. So this is sort of a, things that we may not see right now, but we just need some contingency. So that's part of our R&M expenses. Our insurance is 108,000. We've already received a quote for this, and so we feel very confident about insurance. One nice thing about San Antonio is you don't have the swings of coastal cities because it's more inland. But 108,000 is what we have. Their T12 showed 219,000, and I found they put when they closed on the property, they had to prepay insurance, and so they categorized that in their T12. So yes, this looks high, and it absolutely is high. This is based on a quote, and the group that gave us the quote has done all of our multifamily, so I feel very confident in this number. Real estate taxes, I had mentioned earlier that we're buying the property $800,000 less than the tax appraised value. So day one, and I've done this on two other properties that we bought over the last couple of years, is we're already buying at a much lower value than the tax appraised value. And so every year in Texas, we fight our taxes, we protest our taxes. There's consulting firms that get contingency fees based on how much taxes they can save you based on the protest. Well, this is the easiest protest. It's literally showing them the purchase sale agreement of the purchase price, and that's the purchase price that they will put in their system and bill out on the real estate taxes. So this 245,000 is crazier low than the real estate taxes that they have been paying, and that's just because of the value of what we're buying. We're in essence buying the property for a little bit more than what the debt is on the property, which is just crazy. Utilities kept that flat. And then we've got replacement reserves. This 25,400, this is a lender's requirement. So as we have unit renovations or HVAC replacements, we can tap into this 25,400. It's I always say like gravy on the potatoes. Like it's extra monies and funds that we can tap into. What you'll see here though is the expense ratio is 56.3%. So it's higher in year one, and then it gets over as we push revenue. it gets more into our sweet spot of 53 to 51%. These are the numbers that we typically would see on our portfolio. But year one, just being conservative on the revenue, we're expecting the expense ratio to be about 56%. The other things that we're looking at here, the debt service coverage ratio is 1.75. Crazy. I mean, a few years ago, people were doing deals at like 0.81. They weren't even able to get their debt service paid, and they did a lot of reserves. This is 1.75 debt service. What this means is for every $1 that goes to debt, there's 75 cents left over to pay the bills. And so for Fannie and Mae and these groups, they typically want to see 1.25 for them to do the deal. We're way above that at 1.75. If I look at deal yield maintenance, 9.4, debt constant, 6.7, break even, 66.1%. This is a big reason why I got out of single family early in my 20s, because like when someone moves out of your single family home, you get no rent. I mean, there's going to have to be a lot of units, like 40 units that would have to move out for me not to hit my break even. These are the risk things that we're going through to feel comfortable about any deal that we buy. And cash on cash, 4.8% year one. It grows to 6.6, up to 8.2%. The cap rate at purchase is 6.1% on our expenses. The cap rate on their expenses is 5.5%, which seems aggressive. And the reason is that if you take out, and I thought about taking this number out, but it wouldn't reflect the T12, and I wanted to be transparent on the T12. But if you take the 219,000 and normalize it on what their actual year insurance is, this cap rate is 6.5%. And I mentioned that the interest rate is 5.34. So we're buying a cap rate, we're buying a property 1% higher than the interest rate of the property. And that yield difference could even be further as rates continue going down and we actually lock in our rate. So this is my pro forma. These are the numbers that I feel very good about. I sleep at night, but it doesn't matter what my pro forma is. It's what the property management company feels like they can do. And I typically, sometimes I'll adjust numbers here or there, especially on expenses if they see something that I don't. But on my revenue numbers, I never adjust. So I do my pro forma, I live with it, I'm happy with it. It gives me comfort at night, I can sleep. But then my management company comes in, they have not seen my pro forma, and they are underwriting based on what they've seen in due diligence and how they can operate the deal, what their comfort level is. And so if you look at the net revenue here, they do it 1,552,988. And this number, and these slides will go out so you can dive in for those that really want to look at the numbers. But their net revenue is 1,552,988. My number for year one is 1,496. So I'm gonna stay conservative. I think they're staying conservative as well, which I think we all benefit. Even if we meet in the middle, it's going to outperform our pro forma. But that, from a revenue standpoint, 1,552. Their net operating income. So a lot of these expenses line up with what I have just because I've used MLDC for the last three other properties. I've used MLDC. So I know where their R&M, where general G&A are, marketing. So a lot of those numbers are similar, but their net operating income is 742,000. My net operating income is 653,000. So it's over 100,000. My net operating income year one is about 100,000 less than where our management company, who is the boots on the ground, obviously going to be doing the work, sees that they can push. So it's a little less than 100,000 difference. So I like to show this slide because this is coming from our property management, our boots on the ground. I typically don't adjust our pro forma to match theirs, but when we do budget meetings and we're working on doing our weekly calls, etc., we're focused on this pro forma because they don't know about this one unless they watch this video, which haven't seen them do on our recordings. But unless they do that, then they're not going to see the two pro formas. All right, so let's talk about the Class A. There are three Class A's. For those there are a lot of people here that were on our Candle Ridge Park Apartments. And as you know about that one, that's been doing really well, quarterly distributions, sent out K1s, etc. But how we did that one and how we're going to do this one are very similar. So there's three investment classes. There's Class A, which for those investors that want just cash flow, and they don't really care about the upside, but they want the cash flow. There's a $250,000 minimum to be in Class A. And to do that, for that, you get 10% return. And so Q1, you'll have $12,500. I believe if I do my math in my head, every quarter, 12,500 for that 10%. If you were to do 500,000, which is the max, it would be 50,000. And so how that works is the Class A investors gets paid first, and that in our underwriting already, our um, Excel spreadsheets, it already counts for this. So when we talk about cash on cash on these other investment classes, that's taken into account Class A 10% preferred return. So it's $250,000 minimum, not to exceed 500,000. I'll tell you now, it's very likely already taken because we've had repeat investors and they just want the cash flow. But if you're interested in that, like seriously, there's that QR code. Do it quick, because people they just want that. They want that cash flow. They want that guaranteed 50,000 a year, because a lot of them live off it. And I've got one investor who gets several $100,000 from us every single year, and then his K1s offset his passive income, and he's just living the dream. Anyway, so this is a good one, 250,000 minimum, 10%, but there's no upside. So the Class A investor IR is 10%. The Class A investor equity multiple is 1.5. This is assuming a 5-year hold, and a Class A average annual return of 10%. So this is more for, again, cash flow. Now, then we get into Class B and C. Class B is $100,000 minimum, and how this is structured, and it's extremely favorable in multifamily investments. It's an 8% preferred return, meaning I don't get any monies or our GP members don't get any monies until the investors get whole on their 8% return. And say year one, I'm at 4%. Well, that other 4% is accrued to year two, and then year three, year four, until we sell the property. So those returns accrue, and I like that. And a lot of people are going into these equity splits like 60/40, 70/30 with no preferred return. I'd rather you make more money than me because you're going to tell your friends and your family, and you're going to likely reinvest, and we can all grow together that way. So I've stayed with the preferred return. Another thing I've stayed with is like on this deal, 80/20 LPGP split. It's very aggressive. So 80% of the profits go to those investors based on their pro rata share. 20% goes to the GP. The Class B investor IRR on this, and again, this is based on my numbers that I feel like being, super conservative, like to sleep at night. These numbers are much lower than our management company numbers, but the IRR on this that I feel like we can sleep at night is 16.56, maybe it's 16%. And I'll show you a sensitivity analysis in a future slide, but let's be comfortable with 16.56. Investor equity multiple is 2.05. So for 100,000 investment, you should see a little over 200,000 return, which includes your principal. Class B average annual return of 20.93%. This 20.93%, you're still getting the 4%, but when you take in the exit and your cash flows along the way, that's where this average annual returns. And this is why people get really wealthy in real estate and become real estate millionaires, is because they see a 2x on their return, and then they also have, these great average annual returns. A lot of people invest with self-directed IRAs, solo 401ks, obviously do cash. But you can't get these returns, and we've talked about that early on the equity markets, et cetera. This is a physical asset, and so anyway, so 100,000 will be the minimum on this. The Class C anticipated returns are still exciting, still good. $50,000 investment for this. It's a Class C investor IRR of 15.47. We got a Class C investor equity multiple of 1.96, so a little shyer than 2x multiple. Class C average annual return 19.12%. How this is split though, it's a 7% preferred return, so we're giving a little bit more to the investors bringing in at least 100,000. It's a 7% preferred return with a 75/25 split. After 18% IRR, it goes 50/50, and that's the same with the Class B. And so there's incentive for us to outperform over an 18% IRR. I mean, there's incentive for us regardless because we want to do well by our investors. But this is where we really are targeting to, so that way we can get further growth to you as our investor and then us as a general partner. You'll see cash flow. Again, this is, day one cash flow, first quarter. There are deals where I said, well, we won't do cash flow for the first 6 months and all. And I don't feel that about this property. This is the price that we're buying and getting it at. This is a day one cash flowing deal. All right, so let's look at the sensitivity analysis. And I did this one, I believe this one is, um, yeah. So this one is on Class B. So if you did 100,000 investment, this is the sensitivity analysis for that. And this is where the exit cap rates come into play. So I use CoStar. No one has a crystal ball where cap rates are going to be 5 years from now, 3 years from now, even tomorrow. But where our cap rate typically lines up is what CoStar, which is a leading multifamily research investment company. So their cap rate in 5 years shows San Antonio's trends of 5.8% cap rate, which is in line with interest rates and such going down. So we're at 5.8, but say it doesn't go down. Maybe it's a 6%. I mean, it's still a 2x multiple, 15.5% IR. I mean, even if it's at a 6.5, a 12.9% IR and a 1.8 equity multiple is still, very attractive. That's in a worst case. I can't imagine. We're not even at 6.5%. Now. So, I mean, actually, we're buying this property at 6.5, but it's also distressed. But as deals go down, my point is like these are all extremely really good returns. Even if it starts getting a little more aggressive, 5.5, 5.25, depending on where treasuries and things go, I mean, this could be a home run. But I don't live in the home runs. I like my single basis. And so that's where, that number I feel comfortable with. Now, this deal here, this is for your Class C. This is the 15.7% range. Again, if we're looking at, the cap rates of where it could be 23% or 2.7x multiple, or it could be as low as 1.7, 11.9. It's still beating the returns and removing the volatility of the market, getting great. And this doesn't even include tax depreciation, those paper losses that come by us doing cost seg. So, but I like to show this because it just gives a bigger picture of like, hey, what if Wayne's cap rate isn't right? Well, let's look at, different looks of how the investment will go. All right, so some few more slides here, and then we'll do a Q&A. But deal breakdown, sources of funds. So the total loan is 6.9 million or 6.987 million. Investor equity is 5.2. How this is broken down is the site acquisition is 10,750,000. That's I think their debt on the deal is like 10.2 million. So, slightly over their debt on the deal. Capital expenditures and reserves is 764,000. Acquisition fees 268,000, loan fees 243,000, and then closing costs 161. So this is the use of the funds for the 12,187,500 combined. And again, that's broken out in this 5,200,000 investor equity is what we're raising capital. So the loan breakdown, we've got a purchase price of 10,750,000. Price per door is 84,649. The loan, it's going to be a 7-year fixed rate. I always do 7 years, even though I'm looking at buying in year five or selling in year 5. It's because I don't want to be a distressed seller. I want to be able to time the market, obviously. And if that's year 4, great. If year 3, fantastic. But say year 5 is like really when we're target on selling. What if the market isn't good in year 5 to sell? Well, that gives us another 2 years where we're not, stressing about our loan. Loan to value 65%. This is really important because we're not over leveraging. There's enough equity. We're bringing in enough equity to buy down the loan even further, which increases that debt service coverage ratio, increase or decreases the break even. Remember I mentioned that 66% break even. A big part of that is because this debt is being bought down at a very conservative rate. Deals that are doing 70, 75%, those days are, long gone unless you do a bridge debt. But people out there are still doing 80% plus on loan to value, which is just crazy. Anyway, 65% loan to value is definitely conservative and where we want to be buying the asset day one. This interest only, right now I have it underwritten at 2 years. There's a really good chance this could be a 4 or 5 year IO. So we're working through that with JLL, our debt broker provider. But for a conservative basis, I did 2 years, but this could be a 4 year interest only loan. So we'll look more into that as we get to that over the next week. So let's talk about timeline. So we were under contract March 21st, 2025. We did due diligence on March 26th. We're launching April 8th here, equity raise launch. PPM availability is going to be on Monday. So what we're doing over the next couple of days is soft commits. I mentioned those partners early on in the slides. They also have tranches that they're raising for. So I fully expect our tranche of equity to be raised this week, especially because we haven't raised capital since August of 2024. So again, if you're interested, do the soft commit. It holds your spot. CRI Partners is not raising the full 5.2. We're raising a certain amount, and once that amount is raised, the rest is the other investors, so the other partners. So that's something to be really mindful of. This is not one that like, oh, I'm gonna wait around and all. It's like, here's a great opportunity. If it works for your timing, fantastic. If not, it's totally okay. But we're raising our equity April 8th starting. PPM availability is going to be on April 14th, which I believe is Monday. So we'll have that legal documents, and then we'll be doing investor funding between April 14th and May 30th. The funding has to happen before you're fully committed. So you'll sign the paperwork, you'll wire your funds, and all this is through our portal. When you use your QR code to do your soft commitment, the process is very smooth. It is a portal that will, give you all the updates, show you all your investments, all the K1s, PPMs, everything's in one place. It's similar to like having a Fidelity account or, another investment banking type thing. It's a very sophisticated portal. So you'll do your funding through that, doing the wire or ACH. And then we're looking to close in 60 days. So June 6th at the latest June 30th. And then we're looking to sell in 2030 and 2032. Again, if we close June, the first distribution and such will be the first quarter after. So 90 days after June. And then it'll be all through the portal and ACH to your banks. All right, I've got a couple more slides here. So this is a 506C offering, which is for accredited investors. So to do that, you'll have to verify that you are an accredited investor, and we'll walk through that whole process with you. But in short, if you're an individual filing as an individual on taxes and make 200,000 or more a year, you're considered an accredited investor. If you are married, 300,000 or more is required, or a net worth of 1 million or more, that excludes your primary residence. And there's a couple other nuances, like certain licenses would pass. That's fine. But ultimately, what you'd want to do, and we'll guide you through it, is use verifyinvestor.com. That website will be used to verify your investment, or excuse me, your accreditation. And so we as sponsors don't see your financials and all. You use a third party to verify the accreditation. Once we get the accreditation letter, once the paperwork is signed, and once you wire or ACH the money, then you're in the deal. It's your spot saved, or you're actually in the deal. And then when we close, you are owners of Stratton Park Apartments. And so if you're interested in investing, please commit your investment by CREI Partners LLC.cashflowportal.com. Or if you can just use your phone and just do the scan me here. We'll also send out the webinar and the link tomorrow to send out to everybody. But with that, I want to see if there's any Q&A. So I want to turn it over to live Q&A. So any questions, you should be able to type your questions, and then I will be able to answer. All right, so one of the questions here is how come the seller is selling at such a low price if they're not in distress? So the property is not in distress, like I mentioned. I don't know all the details, but what I'm being told is the lender, there's a certain lender that this person has used, and this lender is calling all debts. So they're calling all property. So they have to go to the lender. So the lender, in essence, forcing the sale regardless of how good the deal is. All right, another question here is on the insurance. What is the forecasted insurance growth? So we budgeted at 4%. San Antonio doesn't see a big increase like what we do in other markets, but it does pretty well. So one of the questions here is, can I verify the store the lender is calling all debt? Yeah, it's verified. It's what they sent their investors in an email. But great question. What is the rating of the school district it's in? I believe it's a three, um, 3 out of 5. What is the lender prepayment cost at 5 years? So that's typically how we do it. It's 1%. So it's a buy down. So it's like 5, 5, 4, 3, 2, 1. And so you'll typically 1% prepayment. That's also part of the underwriting as well. Great questions. All right, I know it's a little late. Just wanted to give it another 30 seconds or so if there's any other questions. A lot of soft commitments have been coming in, so Shelby and I will be reaching out to everybody that has done soft commitments and those that are on this call who may be still thinking about it. And we will go from there if there's any other questions. If not, grateful for y'all's time. Oh, it says, can you repeat what you said about how much you will be raising? So we typically raise 1 million in our deals, but the whole raise is 5.2 million. And so those other partners will raise their portion as well. Some raise 1 million, some may raise 1.5 million, etc. So, but we'll be targeting 1 million for ours, and we should be able to do that in a pretty quick time frame. So our GP Tim is always putting 5%. So we at least have 500,000 in the deal. All right. Well, I will reach out to everybody. All right, one last question here, and then any other questions, definitely email me at wayne@cripartners.com. So we raise together. So we'll have the webinar, those everybody will have their own individual webinar, but we are raising together. We have one portal that they're all tying into. And so we raise together, but everybody has their own set of investors that they go to. Like those that are on this call know CREI partners. They know me. That a lot of y'all have already invested in our deals before, or have been in our circle of influence based on maybe a meetup or reading one of our ebooks, listening to a podcast, etc. And so, but it's very normal for the GPs to raise like this individually. So any other questions, definitely reach out to wayne@cripartners.com. We'll reach out to everybody. I texted many of y'all already on the call, and we'll do other text message tomorrow. So we're available to ask any questions. Appreciate y'all's time and have a great evening.